Well, good afternoon, everyone. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining us today as we take a look at seeking income with credit spreads. Now, with us today presenting is Gareth Ryan. Gareth is the founder and managing director of IUR Capital, LLC, an investment advisory firm that specializes in option strategies for client portfolios. IUR was founded in 2007 and is registered with the Securities and Exchange Commission as an investment advisor, as well as regulated by the United Kingdom's Financial Conduct Authority. IUR Capital is an investment advisor for its clients on the Interactive Brokers Trader Workstation platform. IUR specializes in option strategies for client portfolios, and Gareth Ryan is a frequent or a regular guest on Bloomberg TV. So please join me in welcoming Gareth Ryan for today's presentation. Okay, so Gareth, I'm actually going to put this over on your disclosure slide, pass you the ball so that we can go ahead and get underway today. Gareth, if you can unmute your phone. Oh, there you are.
Yes.
Thanks for joining us, Gareth. Hello.
Thank you, Cynthia. Okay, welcome everyone. Thank you, Cynthia, for the introduction. This is Gareth from IUR Capital. I'm going to be your presenter for today's webinar. I can see some of you are just joining us, so thank you for coming along to today's live event. And as Cynthia mentioned, this recording will be available after the webinar on the Interactive Brokers website. Okay, over on the left of your screen, everyone, you've got our cover slide for today's presentation. That is seeking income with credit spreads. Okay, now I do have a very important disclaimer to go through with all of you for today's presentation. So I would ask for your full attention while I go through this. Folks, options are leveraged products that involve risk and are not suitable for all investors. Before you commit your capital to any option strategy, please ensure you have read the characteristics and risks of standardized options provided by the Options Industry Council. The number is on your screen. You can also request a copy as well through that link. IUR Capital is an investment advisor firm registered with the Securities and Exchange Commission and authorized by the regulated by the UK Financial Conduct Authority. We do not hold any client funds. Client accounts are held at a FINRA-regulated broker-dealer and clearing firm. Neither myself as presenter or IUR is a FINRA-registered representative. Also, IUR is not affiliated with Interactive Brokers LLC or any other FINRA broker-dealer. None of the content discussed in this presentation carries an offer or solicitation of an offer to buy or sell any security or operate any specific strategy. Okay, any securities included in this presentation are for illustrative purposes only and are not intended as recommendations. Execution fees for U.S. options contracts with Interactive Brokers are 70 cents per contract for non-directed orders and $1 per contract for directed orders. Where multi-leg strategies, including spreads, are discussed, the execution fee is per leg, and therefore multiple commissions will apply. The information provided in this presentation is believed to be accurate, but the accuracy and completeness of the information is not guaranteed. Investors should not rely on any information for the maintenance of books and records or for tax, accounting, financial, or regulatory reporting. And of course, most importantly, past performance is not indicative of future results. Okay, so all very important points to bear in mind for today's presentation. Folks, I see that some of you have just joined us. So once again, if you have just joined us, the recording for today's webinar will be available after today's event. You can also request the slides for today's webinar by contacting myself directly. I will put my email address over in the chat panel on the right of your screen. Okay? Okay, let's move on, everyone. A brief background on myself. here for today's webinar. Folks, this is our first webinar with Interactive Brokers, and we hope one of many, depending on the success of today's event. Okay, so as I mentioned, a quick profile on me, the presenter. Folks, I've been trading since I was still a teenager. I initially started out as a euro-dollar currency trader for a proprietary trading firm here in the financial district in London. I then went on to work for a Wall Street broker-dealer in equities and options, and in fact that is where the majority of my options trading experience originated from. I set up IUR in 2007, and as Cynthia mentioned, we are registered with the Securities and Exchange Commission as an investment advisor firm, and of course authorized and regulated by the Financial Conduct Authority here in the UK. Folks, we are an investment advisor on the Interactive Brokers platform. Some of you may already be familiar with the Interactive Brokers platform if you have your account held with them, and the TWS platform. We utilize the TWS Advisor platform for our advisory business for our clients. And of course, we specialize in options strategies for our client portfolios. That's our specialty, folks. We're going to talk a lot about, of course, one particular option strategy today, which is income generating strategies. And as Cynthia mentioned also, you can catch me regularly on Bloomberg and Fox TV. Okay? All right, folks, just bear in mind I'm not English. Chris Raj, thank you for that. I'm from the other side of the Irish Sea, folks, so I just bear that in mind. Hopefully my accent is fine for all of you. If you do have any issues with your audio, once again, please use the chat panel over on the right of your screen. Okay, so a market update. We include this with all of our presentations, folks, because it's important to get some perspective on where we are, in particular with equity markets. SPX, that's the S&P 500, well, we're certainly better than flat year to date, folks. We've had a solid couple of weeks during the first half of May. We've got the S&P at 2120 today, folks. So we are up about 3–4% year to date on SPX, but certainly not as exciting as 2013 and 2014 for the S&P. We'll talk a little bit about reasons for that during today's presentation. What about the VIX? Folks, we do a lot of volatility webinars, and of course the volatility index, that's the metric of risk for the S&P 500, comes up very often. Where are we today? Well, folks, we're back into the 12 range on the VIX. Okay, what does 12 mean? 12 or 13 for that matter. It means that the cost of protecting your portfolio using options is pretty low right now. In fact, it's almost too low when it comes to the volatility index. Right now, folks, you can hedge your portfolio, your long stock portfolio, with relatively cheap put options, either on equity options on the individual stock that you hold, or using something like the VIX or Spyder put options. Okay, we're going to talk about Spyder, of course, a lot during today's webinar for our examples. January, everyone. Well, folks, that's perhaps been the most exciting month of the year so far. We started off this year, everyone, with a relatively uncertain patch for U.S. equities. We had a 2 to 3% drop during the first couple of weeks of January as money flew out of the U.S. equity markets into Europe. Anyone here that's been watching what's been going on here in Europe during the first few months of this year will know that European stocks are pretty much the best performing stocks of global markets right now, everyone. In particular, the German market. We do a lot of business for our clients on DAX index options. That's the German DAX index. Okay, so folks, that's January. What about February? Well, that was the best month for the S&P in a number of years, and in fact, it was the best month for us in quite some time with our credit spread strategy using Spyder Etf. Again, we're going to talk about Spyder during today's webinar. Treasuries, well, they're going the opposite way, folks. Money coming out of Treasuries into other parts of the market. Here we are at the end of QE for the Fed, and interest rates, as you know, are going to come back into play in the coming months. The NASDAQ remains very strong, folks, tech stocks have done very well this year, in particular the NASDAQ 100 and the NASDAQ Composite. Okay, so this year, folks, managing your risk, I've underlined this point for a very simple reason. Managing your risk is going to be more important for U.S. investors right now than it has been over the last couple of years. Why is that? Well, several reasons. Perhaps most importantly, we are not going to get the same kind of action for U.S. stocks in 2015 that we saw in 2013, and for that matter, last year. Okay, it's simply not going to happen, folks, because QE, as I mentioned, has come to an end, and therefore there is not as much propping up U.S. stocks as there was before. So you need to manage your risk and be aware that we've gone so long without a correction in U.S. stocks that, of course, it's not a case of if it will happen, but when. Okay, you can pretty much factor in some kind of correction, folks, larger than what we've had for the last couple of years in U.S. markets. Of course, it's a question of when that will occur and how you protect yourself from that. So, of course, options are going to let you do that with the right option strategy. But higher cash levels is something to consider. Looking for pullbacks as opportunities to do things that you didn't want to do at current levels. And, of course, using the right options strategy as well. The last time we had a major correction, folks, or a correction of note, was October of last year, 7 months ago. That was when we had a 9 to 10% correction on the S&P. Okay, a lot of things went on during October last year, folks, in particular mid-October. During one day, as some of you will recall, during mid-October, the S&P fell almost 50 points in one day. That was the last time that we really had something to talk about when we talk about corrections and opportunities. For us, folks, here at IUR, what we do with client portfolios and option strategies, because we specialize in option strategies, in particularly bullish options strategies, we are looking for big corrections like that to occur. Okay, during times of calm, there are less opportunities for us to do things simply because we do not have a significant pullback to be a seller of puts or seller of put spreads, for that matter, as bull put spreads on Spyder Etf or on other index products. Okay, so big corrections like what we saw last October, that was the last major opportunity for us. Obviously, it's important that you take advantage of that opportunity with the right timing, the right strategy, and the right strike selection. Okay. Chris Raj is asking about the U.S. dollar. I'm going to get to the U.S. dollar a little bit later on, folks, because I do have a couple of other slides coming up where I do want to talk about SPX a bit more. Going back to this 10% correction in October, where did that come from? Well, folks, it was 7 months ago, but here's the thing. That, as I mentioned, is still the last time that anyone here that was sitting with a lot of cash had the opportunity to add to their long stock portfolios or do things with option strategies that would allow them to take advantage of this correction. You all know what happened after that correction, folks. I do have a couple of charts to go through that will show us that reaction after that mid-October collapse in stocks. Small and mid caps, they were the hardest hit. Selling begets selling, everyone, and that's also one of the things that caused that most recent correction. Technicals also are important to bear in mind, everyone, especially the moving averages. We generally do not focus too much on technicals here at IUR, folks. We're more of a macro kind of, we take more of a macro approach and look more at fundamentals than technicals, but it is certainly important to look at moving averages, especially on big products like the Spyder Etf and of course, considering what kind of option strategy you're going to use. Volatility levels, as I mentioned, folks, at 13 and 12 on the VIX, it's almost too low. It reflects complacency in the marketplace when we know that historically VIX levels should be at the high teens and the low 20s. It's been quite a while since we were there, folks. So that does, as I mentioned, reflect some complacency in the marketplace. It's always important to bear in mind where we are with the VIX and how cheap you can insure yourself and your portfolio. Okay? Okay, so this is a very important chart, everyone, that I wanted to include in today's presentation. It's a 2-year SPX chart. Folks, the Spyder Etf is our most actively used vehicle. when it comes to generating income using option strategies. I mentioned, folks, at the beginning that we specialize in the use of option strategies to generate income for our client portfolios that we manage or advise. SPX, of course, is the other vehicle, and of course they are intertwined, SPX and Spyder, relative to the index. Folks, this is a 2-year chart, as I mentioned. Bottom left to top right, price action. Always great to see when you're bullish, when you're holding that long stock portfolio, asset prices continue to appreciate. Look at where we've come from, even from mid-2013, folks. Summer 2013, we were at 1,600 on SPX. Now we're at 2,100, okay? Assets have continued to appreciate in value. Cash and assets have continued to appreciate as funds continue to put money into U.S. stocks. But here's the thing, everyone. Things have started to taper out, okay? I mentioned that 2013, it's unlikely we'll get a repeat of 2013, either this year or next year, everyone, for a very simple reason. 2013 was an outlier year for a lot of asset classes, okay? We had an S&P that rallied something like 25 or 30% in 2013. It rallied about 12% in 2014. This year, as I mentioned, we're up about 3 or 4%. We are looking for things to consolidate in this 2,100 level between now and year end. Folks, what does that mean? It means that we've done 3 or 4% year to date on SPX. We are not looking for anything more significant to the upside. We would be surprised if we generated a 10% gain on SPX. If the S&P does more than 10% this year, we would be pleasantly surprised. Of course, it continues to support our strategy, which we're going to talk about during today's webinar. So again, you can see that correction in October. Let me just briefly pull up the pointer so we can see what I'm talking about. Here we go. Again, that was quite a nasty correction, as I mentioned, in October. But again, look at what happened when we hit that 1,800 level, okay, on SPX in mid-October. Look how quickly new money came in at those lower levels. Okay, we quickly recovered from that correction, and by mid-November, everyone, we were back above 2,000 and heading north towards 2,100. Okay, as we went into year-end, we had a very solid end to the year, everyone. Yes, we did have another mini correction during December, but a very solid start to the year and a 2,000 to 2,100 level that never really deviated during that final period of 2014 and into 2015. Look at what's happening now, everyone. The range has started to narrow, okay? There are option strategies out there that are perfect for this kind of market, okay? One of them is a near-term income-generating strategy. Again, that's the credit spread that we're going to talk about during today. But that credit spread strategy, remember, selling out-of-the-money put spreads on Spyder Etf, that's our most actively used strategy here at IUR, folks, for our client portfolios. That could work very nicely on a near-term scenario where you continue to generate premium regularly to your portfolio simply by selling out-of-the-money premium on Spyder Etf. So that range has continued to narrow. There is a good possibility, folks, that we stay in this range for a prolonged period of time, particularly as we enter the historically slower summer period, okay? I'll talk to you a little bit more, as I mentioned, about credit spreads in the next couple of slides. What about the VIX? Well, again, this chart is something a bit more pronounced when it comes to the VIX price action. This also is a 2-year chart on the volatility index. And again, thank you to IB for this chart. Larger peaks and larger troughs. That's what I would say about VIX price action from this chart over the last couple of years. Okay, now this is not a volatility webinar, everyone. We do have other webinars where we talk about the VIX in more detail. But I will tell you this, historically, about 80% of the time, the volatility index moves inversely to the S&P 500 index. Okay, I'll repeat that for you. About 80% of the time, the volatility index moves inversely. That means there's a negative correlation between the volatility index and the S&P 500. Now here we are today, folks, again, with the S&P around 2,100, volatility index around 13. We should see a volatility index rallying if we do get this much anticipated, long-awaited correction in the S&P 500. However, we do not see this correction occurring at least until the third quarter of this year. Okay, the summer period coming up, folks, the next 3 to 4 months could be very slow in terms of price action, but that does not mean that you won't have an opportunity to generate income. There are lots of strategies, option strategies that will work in this kind of narrow, low volatility market, okay? Okay, so moving on, everyone, let's talk about our main product here, our main vehicle for income. That's the Spyder Etf, okay? As I mentioned at the beginning, we specialize in option strategies, but more specifically, we use a small basket of underlying securities to generate income consistently for our client portfolios. Spyder Etf is the main product, okay, for us to do that. And we like the Spyder Etf for a reason, okay? The great thing about the S&P 500 index, everyone, is that it's a broad market indicator. It's a barometer of many different sectors and industries that let you take a view on the market, all right? We prefer to use the indexes because we can reduce our risk to individual names, individual sectors, individual stocks. That's why we like SPX and Spyder Etf so much. We have other products we'll talk about a little bit later, but by far the majority of our income year to date in 2015 for our client portfolios has been with the Spyder Etf as our vehicle for income. So we're going to talk about the credit spread strategy here. What is the credit spread strategy? Well, very simply, it's a vertical spread, okay, being sold on the opening transaction, okay? What's the great thing about a vertical spread? Very simply, it's a defined risk, defined reward scenario. That means that before you even take the position, you can define your maximum risk and your maximum return with this vertical spread strategy. Buying one option, selling another at the same time with the same underlying and the same expiration, but at different strike prices, okay? That's the important part. Because we're selling this spread, let's say it's a put spread in this example, because we're selling this put spread on the opening transaction, it's always at a credit, okay? That means the premium is received on the opening transaction. Our objective is very simple, everyone, with this credit spread strategy. When we sell this put spread on Spyder Etf on the opening transaction, we of course simply want that put spread to expire out of the money, OTM for short. And if it does, if it expires out of the money, we get to keep all of our premium that we received on the opening transaction. Doing this consistently, folks, is where the income generation is achieved. And that's, as I mentioned, what our focus has been for the majority of our client portfolios year to date. Okay, now a question from Nick here. Nick is asking, can we sell a Spyder 200 strike put and buy a 197 put for credit? Yes, that's a $3 put spread, folks. Okay, Nick is asking about a $3 put spread. Can we sell a 197 200 put spread for a credit of 21 cents? Yes, if that's what the price is now on your screens, folks. I'm not looking at that at present, but yes, if that's a $3 put spread that you're referring to, you haven't mentioned what expiry you're referring to, Nick, but yes, that's a $3 put spread. I would tell you, Nick, and to everyone here, that we focus primarily on $2 put spreads, selling credit spreads on $2 put spreads, looking to generate at least 20 cents credit. Okay, now I do have several slides coming up where we get to talk a little bit more about this in more detail. All right, Nick. So Nick is mentioning June 19. Yes, that's a 197 200 put spread that Nick is referring to. So it is about 6% out of the money that he's referring to, where he is selling 197 200 put spreads, picking up 21 cents credit on the opening transaction, and of course, he would get to retain the entire premium. He would keep the entire premium if Spyder is anywhere above 200 at the June 19 expiry. Okay, Nick, I'd love to talk to you a little bit more about that after today's webinar. Let's move on, folks, to talk about the Spyder Etf in more detail. I've talked about credit spreads only, okay, and our examples will refer to credit spreads in this webinar, but there is something else. I mentioned that we are in a very narrow range, everyone, a 3 to 4% range on SPX, and we have been since February, okay? That's a 3-month time horizon. What can you do with option strategies that you cannot do with a simple long stock portfolio? Well, folks, in a sideways market like what we've had in the S&P over the last 3 months, your stock portfolio will have less volatility, certainly, but it's not able to generate the amount of income that you could generate using an option strategy, okay? The credit spread strategy can continue to generate income for your portfolio even in a sideways market. That's what we like most about credit spreads, okay? You can sell out of the money put spreads continually, okay, on each traditional monthly expiry on Spyder Etf, and that will be a consistent income into your portfolio, all right? That is the great upside about credit spreads relative to simply owning a long stock portfolio that would require the market to continue to rally in order for your portfolio to continue to perform for you, all right? Spyder Etf, the Iron Condor, this is where we have 2 spreads, folks. This is the classic neutral strategy where you have a narrow range on SPX and you're expecting that range to continue, all right? This involves selling an out-of-the-money put spread and selling an out-of-the-money call spread. It creates that net credit to your portfolio. Here's the great thing, everyone, about put spreads and call spreads together. You have 2 premiums coming in, okay? You've got your premium on the call spread and your premium on the put spread, both of them coming in together, all right? 2 tranches of premium, which is what we like. Now, it's very simple. If we're talking about June 19 expiry in this example, folks, that means we're about 30 days away. You need both spreads, the put spread and that call spread, to expire out of the money, all right? Maximum premium is retained where all 4 legs have 0 value at the expiry. Here's the other important thing, and this is one of the upsides of the Iron Condor, all right? Not just the credit spread on its own, which is, of course, where you have one side on its own, either a put credit spread or a call credit spread. Time decay is your friend as a seller of options, everyone. Anyone here that is in the options business will know that sellers of options, time is on their side, okay? For the buyer of an option, of course, time is against them because they own a wasting asset. When we get to the final 30 days of an option's life, you also know, some of you that are dealing in options regularly, that time decay really starts to work for you, okay? That's the great thing about either selling puts or put spreads, for example. Both of them will continue to erode in time value, and that's partially where the income is being generated for your portfolio. That's the great thing about sideways action, like what we have right now today, everyone, on the S&P 500, okay? So 2127 is where we are right now. I mentioned we have been in this 3 to 4% range on the S&P since February. Have a look at what a normal stock portfolio would have been doing, what the performance of a long stock portfolio would have done between February and today. Here we are in mid-May, folks. The performance of that stock portfolio on its own. And then look at what an options portfolio would do where you are simply looking to generate income, okay, using either the Iron Condor or selling out of the money put spreads, okay, each month for that 3-month time horizon. How much premium can you generate? That is the great thing about option strategies, everyone. They will outperform a stock portfolio if you have a sideways market like what we've had on the S&P 500. And that's why, folks, our client portfolios have been performing so well since January of this year, because of this flat market and our consistent approach to generating income month in, month out for our client portfolio. So remember, we're always selling to open on the Iron Condor or on the credit spread, and we're always generating cash into the portfolio on the opening transaction. A couple of questions here. Steve is asking about SPX credit spreads. Do we use SPX credit spreads instead of Spyder? Well, Steve, that's a very good question. It's one we get a lot on our webinars where we talk about credit spreads. Folks, the answer to that is split into 2 or 3 parts, but I'll summarize it very simply. Yes, commissions are lower on SPX than Spyder simply because you're trading a lower number of contracts. But there are unique things about Spyder including the fact that it has a dividend every quarter, and you can trade that dividend as part of your strategy, okay? Every quarter, folks, Spyder generates a dividend, but the price of the Spyder ETF is also trying to reflect the dividend. You can take advantage of that along with your approach to income generation on Spyder, all right? The next expiry, the next big expiry, folks, traditional expiry is, of course, June 19. But bear in mind, we also have a dividend on Spyder ETF on June 19 as well, okay? Between now and then, folks, Spyder ETF's price will continue to accrue that dividend, and therefore Spyder ETF will start to move above the SPX price. And this is something you need to bear in mind, everyone, especially if you really want to be successful with generating income consistently and you want to focus specifically on Spyder, then you need to understand this. And this is one thing that we do a lot for our client portfolios, balancing the premium generation and the commissions involved with that dividend, okay? Yes, SPX is a different product because there's no dividend involved, but you have to bear in mind the pros and cons of both together, and also the tax advantages and disadvantages of both of those together as well. That was a question from Steve. Steve, I'd love to have a chat with you more after this webinar about why we prefer Spyder over SPX, okay? Andre is asking, how far away are the two spreads? Well, this is the great thing, Andre. Strike selection is something that a lot of you have a problem with because you can understand the strategy, but strike selection is where you need some kind of input, and that's, of course, what we do on our Options Advisor account, everyone, with Interactive Brokers. So I'll talk to you more about that, Andre, a little bit later. Jason is simply complimenting the theta strategy. Yes, theta, folks, is part of your time decay. Okay, it is the time decay, in fact, and it's what is generating income for you with that credit spread strategy. Raymond is asking, do we only do monthlies or do we focus on weeklies as well? We do both, folks. We focus on traditional monthly expiry with the credit spread strategy and the weeklies as well. Folks, weeklies are great for a very near-term time horizon, of course, but you do have to be closer to at the money with your strike selection when you're looking at premium generation. Okay? All right. Yes, I mentioned strike selection. Folks, strike selection is the unique part about income generation. That's what I would say when it comes to the credit spread. A lot of you can understand the credit spread strategy and how it is set up, but the strike selection is really where you need some kind of input. And again, this is exactly what we focus on with our Options Advisor account, everyone, which I'll talk to you about at the end of the webinar. On your Interactive Brokers account, we'll look at strike selection with you, look at what your approach to risk will be, and then decide, is that too close to at the money or is it too far away from at the money? Remember, as a seller of options, folks, the closer to at the money you are, the more premium you can generate as the seller. All right, the further away from the at the money you are, the less premium you're going to generate. Okay, whether it's on the call spreads or on the put spreads. Okay, now we talked about income generation. We're talking about monthly income generation in particular. So you're looking at the traditional monthly expiry. Your question that you have to ask yourself is how sensitive you will be with your strike selection on the S&P 500 index. If you're farther out of the money, folks, with your strike selection, you can allow bigger moves, bigger daily moves in the index, okay? But the problem is you're going to have lower income because you're receiving lower premium. Look at what your target will be for monthly income generation, okay? Look at how much premium you can generate with your strike selection. This is exactly the kind of thing, as I mentioned, we work with you on through our Options Advisor account. And look at how far away out of the money you can be. If you want to be more conservative with your approach to risk, everyone, you can be further away from at the money, either on Spyder or on SPX. Look at something like 5 to 10% out of the money range. Look at what premium is available on the traditional monthly expiry. All right, remember, you can do this on the put spread and on the call spread side, either as the IUR Condor, or if you want to take only one side, that is selling put spreads or selling call spreads on their own. Okay, remember, if you do both together, folks, with that IUR Condor strategy, yes, you've got the benefit of having two premiums, both premiums coming in from the sale of the put spread and the sale of the call spread, but you are more neutral in your price outlook for the underlying index. Remember, this is a $2 put spread, folks. That means the maximum risk for you is that $2 value. The spread cannot have anything more than a $2 value at expiry, and it will only have its $2 maximum value if both legs are in the money at the expiry. Remember, also, we are looking to achieve a minimum of 20 cents credit, okay? On a $2 put spread or a $2 call spread, we are seeking to generate at least 20 cents credit on our opening transaction, okay? That means that I'm picking up 20 cents credit or $20 per put spread or call spread contract I'm receiving, and I'm simply looking to retain all of that premium, all right? Remember also that if that's 5% out of the money, okay, if it's a 5% out of the money put spread, we can allow Spyder to decline by up to 5% if we want to stay out of the money with our position, okay? Anything more than 5%, folks, then you are at the money and you will move in the money if Spyder continues to decline. So you will need to adjust your position, or if you are seeking to take delivery of the Spyder, then you will do so at the short leg strike price. Bear in mind also, folks, with the IUR Condor, it's a neutral strategy once again. It is not a directional strategy like bull put spreads or bear call spreads, okay? You are taking a neutral outlook on the underlying index, so you're neither bearish nor bullish, but you have the opportunity to generate income on both the put and the call spread side. One question I get a lot from all of our previous webinars where we talk about the IUR Condor in particular is what the adjustment would involve if the Spyder moves too far to the upside or too far to the downside, okay? What would you do with the IUR Condor? My answer to that, folks, is very simple. You take off the side of the IUR Condor that is not working for you. That's the most simple and direct answer that I can give you. Yes, there are other adjustments you can make, but that, of course, is what we would focus on through our Options Advisor account. Again, I'll talk to you more about what we do on the advisory side near the end of today's webinar. Now, risk and return. Remember, that 20-cent credit, that is the maximum we can make as a seller of the option, okay, or the seller of this put or call spread. You do have risk involved, folks. It's important that you manage your risk. We are risk managers first and foremost for our client portfolios. When you're dealing in options, folks, you are dealing in leveraged products, and therefore you need to understand risk and look at how you can protect yourself against significant moves, okay, either overnight or over several days in the underlying market. The credit spread strategy, as I mentioned, is the main theme for what we're talking about during today's webinar. It is there to generate consistent income for your portfolio. But an important point I would make to you, folks, is that at times when the market becomes very volatile, you will need to adjust your credit spread strategy. Okay, your strikes will need to be adjusted. You'll need to hedge it, or you'll need to roll down the strikes, which is one of our adjustments actually, rolling down strikes either on the put spread or rolling up the strikes on the call spread. Lots of things you can do, folks, but there will come a time, everyone, where the market no longer becomes sideways in its price action and a direction starts to form, and therefore you need to react to that. You need to make sure that you're managing your position, and of course that's what we do with our client accounts here at Interactive Brokers, managing positions including the credit spread. Now, I mentioned if the index moves significantly in one direction with that IUR Condor strategy, either the put spread or the call spread will need to be adjusted. Okay, that is where you are running the IUR Condor. But folks, as I mentioned, the credit spread for us since the beginning of this year has primarily been on the put spread side. That is, selling put spreads out of the money on their own without a call spread above that. Okay, and then we would hedge the position if we need to. Remember, these are $2 put spreads, and in general, folks, we set our risk manually. That means we use manual stops where the put spread moves from 20 cents up to 30 or 40 cents. We will set our manual stops based on that. Okay, now some important notes here about the Condor strategy as an income strategy. In this example, folks, I have a 5% monthly target for income, but I have to accept that in some months it's simply not going to be possible to generate that amount of income. Either the market becomes very volatile or there's too much uncertainty in the underlying index, or there are big events coming up which would prevent you from taking positions, credit spread positions for income generation. So yes, it certainly helps to have a target, a monthly target, but you may have to accept a lower percentage return of income, okay, simply because market conditions were not favorable for the strategy. As I mentioned, everyone, since February, we have had this 3-month period where income generation has been achieved for us with our client portfolios using the credit spread strategy simply by generating income each month, selling out of the money put spreads on Spyder Etf, on NDX, on the IWM, that's the Russell 2000 Index ETF, also one of our most actively used vehicles for income. Okay, so yes, we've had this 3-month period where we have successfully generated income using the credit spread strategy in a very narrow sideways market for the S&P 500. And yes, it may continue, folks, throughout the summer if we have a lack of direction throughout June, July, and August. But we are expecting volatility to return to the market, folks, at some point, and therefore it's important that we're ready to take action and adjust our strategy and our positions when that does occur. Implied volatility, folks, another important thing to bear in mind for anyone in the options market. Remember, implied volatility gives you the price of your options, okay? Higher implied volatility means higher option prices. Lower implied vol means lower option prices. As a seller of options, folks, someone consistently selling premium, remember that if you are selling premium in a low volatile market, you have that risk of implied volatility spiking or at least increasing, and therefore that will affect your positions on your option prices. Okay. Okay, Spyder Etf has been what I've been obsessing with over today's webinar, folks, but Spyder is not the only vehicle out there. IWM ETF has also been one of our most successful vehicles as a seller of out-of-the-money put spreads, as bull put spreads on IWM since January. Take a look at your chart on IWM if you'd like after today's webinar. Here we are today at 124.50 on IWM. The range has been pretty narrow, everyone, since January. It's been a 5-6% range, nothing more as far as I can see on IWM. We have consistently been selling premium using out-of-the-money put spreads, out-of-the-money bull put spreads, as credit spreads on IWM since January. It has a similar structure. Yes, there are a few differences, but Spyder Etf and IWM are relatively similar in how they are trading, and of course the multiplier on the options contracts. The range last year was 104 to 120 in IWM. As I mentioned, we are sitting slightly above that. Can you run an income strategy on IWM similar to what you can do with Spyder Etf? Well, yes, folks, if you have the right structure and the right approach to risk, and you can manage your positions and any adverse price movements in the underlying, like what we do here at IUR with our options advisor account, then yes, consistent premium can be generated to your portfolio even in a sideways market like what we've been in for quite some time now, folks. A lack of direction can be a problem for long stock portfolios. Okay, but a lack of direction can also be gold dust. Okay, it can be the biggest advantage for premium generation strategies like the credit spread. And this, folks, 2015 could be one of those years where you have a lack of direction for a prolonged period of time in the S&P, but those who are consistently selling premium will have the opportunity to outperform, significantly outperform the underlying index. Remember, we use the S&P as our benchmark against this credit spread strategy for a very simple reason. It is a direct benchmark. That means we're selling premium on the index. We're not taking the benchmark S&P and then doing something else with another stock. No, the strategy we're using is benchmarked against its underlying vehicle, and that's allowing us to have a real accurate indicator of our performance on the credit spread strategy, okay, both on Spyder and on IWM. Okay, some important points here on the credit spread. Remember, it's generally profitable if the underlying security price is above the higher strike price of an out-of-the-money put spread. and conversely below the lower strike of a out-of-the-money call spread. It's always one transaction, so the long and short legs of each put spread are always traded together, sold together as a credit spread, and therefore it's a net credit or a net cash inflow to your account. What about your loss, folks? Well, of course, that's where that will occur if you have a significant, on a put spread, that will occur where there is a significant decline in the market and your put spread moves from out of the money to in the money. Here's the important point though, folks. In all of the time that we've been doing this, everyone, we have avoided any scenario where our out of the money put spreads have moved from out of the money to in the money on Spyder Etf. Why is that? Well, very simple, folks. We manage all of our client positions day in, day out, from market open until market close. All right? If we need to adjust positions, i.e. a put credit spread on Spyder, for example, by rolling down the strikes, well, we'll do that on any given day that we need to. Okay? That means that we can avoid any scenario where we've sold a $2 put spread on Spyder for 20 cents and it's gone to $1 or $1.50. That has never occurred for us, folks, and the simple reason is we manage our positions and we adjust them when we need to. This is called active management of the positions, folks. You have to do that with this kind of strategy, okay? Okay, some important points here, everyone. We run all of our portfolios like a business. We have to. Options portfolios, folks, are something different to stock portfolios. You have a lot more opportunities in an option portfolio to consistently generate income for that portfolio than what you have with a traditional stock portfolio. We believe that is true for a very simple reason. This price action, as I've talked about during today's webinar, over the last 3 months has been a perfect example where an option portfolio that is using income generation strategies should, more often than not, outperform a traditional stock portfolio, using, as an example, the Spyder Etf, our most actively used vehicle, as I've said during today's webinar. You should never allow one specific event or price move to affect your portfolio, especially when it comes to dealing in option strategies. That is why, everyone, we generally avoid earnings season. Okay, not only do we avoid earnings season itself, more specifically, we avoid taking option positions on individual stocks, okay, individual equities during their earnings season, simply because it's a very binary event and it's not a price action from an earnings report is not necessarily reflective of the overall trend for that stock. Again, this is why I've repeated our use of the Spyder ETF. You get to avoid individual stock risk by using an index ETF, everyone. Spyder ETF is perhaps the most liquid product out there when it comes to dealing in options. If you look at your options chain, you'll see exactly what I'm talking about, okay? And again, that's why avoiding earnings season on specific stocks is something we like to do continually. Look at your objectives for monthly income, okay? I mentioned earlier in my example that you could set a 5% target for monthly income. Can you achieve it with the strikes that you're selecting when you're selling put spreads for income? If not, do you need to adjust it? And do you need to hedge that? Do you need to take out some protection with option strategies to protect your further out of the money credit spread? This is the kind of thing that active management of the portfolio involves. Provided that we are continually generating premium, then we can do that on a regular basis. We are not stock pickers here, folks, okay? Options portfolios for us are not for stock picking, okay? We use a small basket of underlying securities, no more than 10 right now, that we will use continually to generate premium, okay? We're not concerned about looking at individual names and looking at the performance of individual names for our strategy of income generation, okay? And perhaps most importantly, strike selection is one of the things that we here as an investment advisor will work with you on when it comes to income generation. I know a lot of you are working on your own with your Interactive Brokers account. Folks, we are set up with the Interactive Brokers platform to advise you, either on the advisory or on the managed side, which I'll talk to you about shortly. But it gives us the opportunity to provide you with the kind of input that you may not have looked at, some things that you may not have considered, which could seriously affect your position. okay, especially when it comes to dealing in options, all right? Stock portfolios and option portfolios, two different things, everyone, and they're set up to achieve different things. With our approach to income generation, we're focused entirely on income. We are not concerned about being right about direction, okay, with this credit spread strategy. Now, I talked about the fact that we're set up with Interactive Brokers right now as an investment advisor. Folks, very simply, we work with you in one of two ways on the Interactive Brokers platform. Firstly, the Options Advisor account. All right, this is where you get to stay at the wheel, essentially. We would work with you on several things, strategy perhaps being the most important. Okay, we'll look at what your objectives are. I know a lot of you have introduced yourself to credit spreads recently because you were concerned that the S&P and the broader markets in the US may not have the same kind of returns for you in your stock portfolio over the last couple of years. This is exactly why income generation strategies should come to the forefront and why the credit spread is something that we've been focusing on for our client portfolios. Income generation using this credit spread strategy is one thing. Look at the underlying security. Look at strike selection, your position sizing, and how you're going to manage your risk. These are all things that we do through our Options Advisor account directly with you, okay, by phone and by email on your portfolio, okay? If you're set up with your Interactive Brokers account now, we can get set up with you on the advisory side very simply. Again, we can talk to you directly after today's webinar to do that. As the advisor will advise, undertake, and monitor all positions. I talked about the fact that option strategies and positions, option positions, need to be managed day in, day out. Okay, some of you who are very actively dealing in your own portfolio do need to manage your positions day in, day out. That's exactly what we're here to do on our Options Advisor account. This Options Advisor account, folks, it's a great place to start if you're looking to try us out, essentially, to evaluate us whilst allowing you to stay in control. That's what the Options Advisor account is for. For some of you that are perhaps too busy with other things going on, that you're not able to really manage your positions frequently, well, and day in, day out as such, well, that's what the Managed Options account is for. But we're going to talk about the Managed Options account on our upcoming webinars and also with you directly. You can see what our advisory process is on screen. Again, it's very straightforward. A lot of you will be very familiar with Spyder Etf, but you need to focus on the income generation. Again, I've got quite a few questions coming through here. We won't have the opportunity to talk to all of you during today's webinar and answer all of these questions, but what I would like all of you to do, I'm going to put my email on screen. Here we go. Folks, I'd like to ask all of you that have come along to today's webinar, and for those of you who are watching the recording of this webinar, to get in touch with me directly on that email address. We'll talk about what's been going on over the last couple of months and how you're going to generate income, as I mentioned, if we have a sideways market during the summer period. Now, let's get through some questions here. Let's take a look here. Okay, I'm going to start off with, let's see, next question. Okay, he's talking about margin. Folks, yes, options do require margin generally. With Interactive Brokers, you have several account types, as you can see from the IB website. But yes, we generally would deal on margin and option positions. They are leveraged products, of course. Okay. Raymond is asking, are we measuring our returns on cash? Yes, Raymond, for the very simple reason that on the credit spread strategy, your cash is being used as the collateral. Okay. If, for example, you have a $100,000 account, pretty much all of that for the strategy will be cash. Okay. There will be no actual stock being held with a credit spread strategy. Okay. You're simply generating your return on cash. So it's a very simple, direct way to measure how much income you generate. Let's see. Nick is asking, how much of an account would we risk on one credit spread? 10%? Well, again, this is where things get a bit more specific to you as an investor, folks. So we'll look at the size of the account and your approach to risk and other circumstances as an investment advisor, and then we'll come up with a suitable position size. Nick, let's talk to you directly about that after today's webinar. A couple of other questions here. Let's see. Jason is asking, when do we roll? When you roll, do you increase the quantity? If you're talking about rolling down strikes when we have to adjust a credit spread, a put credit spread, not necessarily increase the quantity, no. It will depend on several circumstances. Again, we may take the same position size. Again, those are more specific things that we would talk about with you on the options advisor account. Okay, let's see. MK, are you suggesting you've never been whipsawed? When you use the phrase whipsawed, MK, I'm assuming you mean do we have to adjust? Yes, certainly. The last time, folks, we had to adjust a put credit spread on Spyder, I can tell you very specifically, the last time we had to do that was in January, okay? And it was a simple roll down of our strikes on our Spyder put spread. Let's take a look. Kisraj is asking, I'll go through a couple more questions, folks, and that will be it for today's live webinar. And then I'll be very happy to answer any other questions directly by email. Let's take a look. Andre is asking, do we use TWS option modules and Risk Navigator to manage positions? Yes, we do indeed. And folks, those are two very important parts of what we do with our TWS advisor platform with Interactive Brokers. Okay, so Andre, we can talk to you more about that directly after today's webinar. Let's take a look. Mike is asking, can you give a specific spread you'd put on today on Spyder to generate 5%? Okay, Mike, unfortunately, we're not able to give direct advisory on a live webinar. That is, of course, what the Options Advisor account is for. Mike, if you have your account with Interactive Brokers right now, we'd love to talk to you more directly how to do that after today's webinar. Mike, you can drop me an email. My email address is on the left side of your WebEx screen. Okay? One more question, folks, and then I'll have to jump off for today's live webinar. Vadim is asking, how many Condors do you hold per week? Folks, right now, I can tell you that the June expiry on Spyder is our next main expiry. And yes, we do have a Condor strategy on June. We are looking for sideways action, as I mentioned, on Spyder to continue, albeit slightly bullish price action between now and mid-June. So yes, we do have a Condor on Spyder, but for the traditional monthly expiry in June. That's not a weekly strategy. Okay, Vadim, I'd love to talk to you more about that in more detail after today's webinar. Nick is asking, do we get out of positions if in the money on expiry? Firstly, we would never allow positions to get in the money on the expiry day. That has never occurred to us in all of the time that we've been using the credit spread strategy. Out of the money, folks, OTM, that is our priority as a seller of options. All we need is income generation to be achieved from our positions expiring out of the money. Okay? All right, folks, once again, you've got my email on the screen. Again, I'd love to talk to you all about this Options Advisor account provided by IUR through the Interactive Brokers platform. So please do get in touch with me after today's webinar. Okay, folks, I'm going to leave it at that for now. I do hope we will be back again with Interactive Brokers perhaps in June. If you'd like to have me back and you can tolerate my lovely Irish accent, please do drop Cynthia at Interactive Brokers an email and let her know that you'd like to have me back on the Interactive Brokers webinar schedule for June. Okay? Folks, thank you all for coming along to today's live event. Once again, it will be recorded, and it is being recorded for playback at a later date. And the slides will be provided to you all by email. You can drop me an email once again on that slide on your left of your WebEx screen. Folks, thank you all, and I look forward to hearing from you all very soon. Thank you.